Millions of Americans diligently put a percentage of every paycheck into a 401k or index fund, relying on the assumption that strict financial regulations keep these passive accounts safe from extreme speculative risks. But over the next few months, that assumption will be tested. This scale comparison shows the combined $4 trillion valuation of three private companies preparing to go public: SpaceX, OpenAI, and Anthropic. That total dwarfs nearly every historic initial public offering on record. As this graphic illustrates, you might not actively choose to invest in these companies, but your retirement money will flow straight into them anyway. Thanks to a series of quiet rewrites to the financial system's rules, your index fund will be forced to buy these newly issued shares automatically. A small group of early insiders bought into these tech giants at low prices, and now they want to cash out at peak valuations. To do that, they need buyers capable of absorbing trillions of dollars in stock. The only pool of capital large enough to handle that volume is the collective retirement savings of the American workforce. Normally, major index providers like the S&P and the Nasdaq act as gatekeepers. They have strict requirements designed to protect passive investors from volatile, unproven new listings. But those protections were recently completely dismantled to make way for this specific, massive wave of new tech offerings. On May 1st, the Nasdaq introduced a fast entry rule. This timeline shows the standard required waiting period for a new public company to trade on the open market, proving its stability before joining the index, was suddenly compressed from a full 365 days down to just 15 days. But the most aggressive change involves a company's public float, the percentage of shares actually available for the public to trade. Under old rules, a company like SpaceX, planning to list with a tiny 4% float, would be automatically disqualified. Now, the index applies a hidden multiplier. A 4% float is treated like 12%, forcing index funds to artificially triple the stock they must buy. These synchronized rule changes remove choice from the equation. They convert your passive retirement account into a guaranteed buyer, ensuring early tech investors have a captive audience when they finally sell. To understand why these insiders are so eager to sell right now, you have to look at the math behind the artificial intelligence boom. While tech giants report record-breaking headline profits, they are simultaneously burning billions of dollars to build out their AI infrastructure. A large portion of their reported profitability is actually built on a circular accounting trick. This flow cycle illustrates how big tech companies inject billions of investment dollars into AI startups like OpenAI and Anthropic. Those startups then turn around and spend that exact same money renting server space and computing power back from the original big tech companies. The tech giants record those server rentals as legitimate top-line profit, and they use that paper profit to justify taking on billions in corporate bond debt, borrowing massive sums to fund even more AI infrastructure and keep the cycle spinning. If you strip away the circular spending and look at free cash flow, the actual money left over after a business pays for its operations, the margins for several of these tech leaders are rapidly collapsing towards zero. When you break down a company like SpaceX, their satellite and rocket divisions actually generate real revenue, but their AI division burns through over $1 billion a month, dragging the entire corporate entity into a severe net loss. This artificial spending loop only works as long as private investors agree on the high valuations. By taking these companies public immediately, insiders can validate their paper profits with real cash from your 401k, before the open market realizes the math doesn't add up. The timeline for these offerings is shrinking because external, real-world economic pressures are starting to threaten the delicate flow of debt keeping the AI loop alive. Geopolitical instability, particularly the ongoing conflict in the Middle East and shipping lane closures, creates a very real risk of a sudden, drastic spike in global oil prices over the coming weeks. If oil prices surge, foreign nations that import oil will suddenly need an influx of US dollars to pay for it. To get those dollars quickly, they sell off their largest liquid assets, US Treasury bonds. When the global market floods with bonds, the US government has to offer higher interest rates to attract new buyers. Higher national interest rates immediately increase the cost of borrowing for everyone. The tech industry relies heavily on cheap corporate debt to fund their massive AI builds. If borrowing suddenly becomes expensive, their entire spending loop suffocates. Tech insiders are essentially racing a macroeconomic ticking clock. They are pushing forward the largest initial public offerings in history because they need to extract real capital from the market before rising interest rates snap the debt loop completely. History suggests that even when a technology achieves global adoption, the people who fund the initial build-out rarely walk away with the profits. In the late 1800s, massive capital flowed into building the American railroad system. The physical infrastructure successfully connected the country and modernized commerce. But almost every initial investor who funded that expansion went bankrupt, as the individual companies collapsed under their own debt. The exact same pattern repeated in the 1990s. Companies spent hundreds of billions of dollars laying fiber optic cables across the ocean floor. That physical infrastructure became the backbone of the modern internet. But the early investors who paid for it were wiped out entirely when the dot-com bubble burst. Artificial intelligence is a physical reality that will likely alter how industries operate for decades. But purchasing this infrastructure at multi-trillion-dollar valuations means absorbing the massive initial losses that historically precede profitability. Institutional investors understand this historical cycle. Their strategy is to wait for the speculative bubble to pop, let the original companies fold, and then buy the valuable infrastructure out of bankruptcy for pennies on the dollar to build the actual profitable businesses of the future. The problem is, the current financial rules are intentionally positioning the average worker's retirement account to be the primary shock absorber. Your 401k is being designated to take the hit. This risk is compounded by severe market concentration. This tree map of the S&P 500 shows that right now, nearly half of the index's entire market capitalization is tied directly to a handful of AI-related stocks. An AI debt loop collapse would ripple through the entire economy. Because index safety mechanisms have been dismantled for these specific listings, a sudden correction in tech now directly threatens the stability of the broader market. You need to review exactly what your index funds hold. As the largest artificial tech boom in history reaches its peak, the insiders have realized it is time to cash out, and they have rewritten the rules to ensure your retirement savings provide their exit liquidity.